Something seismic just happened in Hong Kong, and the global markets are already feeling the tremors. $1.5 billion in fresh capital didn't just trickle into fintech, it exploded across a select group of crypto-driven firms like a financial lightning strike. But this isn't about hype coins or fleeting trends. This is a strategic high-stakes push backed by regulated platforms, institutional trust, and government alignment. Hong Kong isn't asking for permission anymore. It's announcing dominance. And the world is watching, wondering, is this the blueprint for crypto's next era, or the beginning of another overhyped spiral? The money rush. Why investors are betting big on Hong Kong's crypto market. There's a reason $1.5 billion just poured into Hong Kong's fintech scene. And it's not just investor FOMO, it's calculated ambition. For years, Hong Kong hovered between traditional finance and blockchain experimentation, but recent regulatory clarity has flipped the switch. Now, instead of battling uncertainty, investors are racing to lock in positions before the door closes on early advantage. It's not about chasing crypto hype, it's about owning a stake in Asia's next digital financial capital. Behind this capital wave is something deeper than bullish sentiment. It's conviction backed by institutional money. Sovereign funds, legacy banks, and aggressive venture firms aren't just watching, they're writing checks. Why? Because Hong Kong offers something rare in the crypto world: structure, stability, and proximity to China without being bound by its crypto bans. This rare regulatory balance makes it the ultimate launchpad for fintechs wanting Asian exposure without Beijing's chokehold. This isn't just about digital coins and token speculation, it's about rebuilding financial architecture from the ground up, with blockchain as the base layer. Investors see this as a once-in-a-decade opportunity to fund companies that won't just ride crypto waves, but shape how money moves globally. Hong Kong has stopped flirting with innovation and started courting it, with capital flowing in like proof of a bet that's already paying off. Stablecoins, licenses, and strategy, where the $1.5 billion is actually going. It's not just the size of the $1.5 billion raise that matters, it's the precision with which it's being deployed. These funds aren't vanishing into vague crypto innovation promises. They're being funneled into targeted zones like stablecoin development, real-time cross-border payments, and blockchain-native banking rails. This is no spray-and-pray fundraising. It's a tightly coordinated capital strike aimed at flipping the fintech script across Asia and beyond. Licensing is the unsung hero here. Hong Kong's move to roll out its virtual asset trading platform, VATP framework, didn't just legalize crypto, it gave institutional investors a checklist, a roadmap, and above all, confidence. With government-blessed crypto exchanges and regulated stablecoin infrastructure, fintechs can now scale without worrying if the rug will be pulled. That stability is attracting global partners and igniting growth faster than speculative boom cycles ever could. What's fascinating is the shift in language. CEOs aren't talking about crypto adoption anymore. They're talking about compliance pipelines, sovereign-level partnerships, and sandbox digital currencies. This is the kind of language that comforts central banks, reassures hedge funds, and unlocks billions. In short, the $1.5 billion isn't funding a crypto revolution, it's fueling a regulatory-approved, institution-friendly reinvention of money. The stars of the raise. Who are the key players leading this crypto surge? While the headlines shout numbers, the real story lies in the names behind the raise. OSL is more than just another digital asset exchange. It's one of the few licensed platforms in Hong Kong, giving it a regulatory edge that rivals can't touch. D-Mall, originally known for retail digitization, is pivoting hard into AI-infused payments and merchant-side blockchain tools. And then there's SenseTime, the AI unicorn now eyeing crypto through a machine learning lens, blurring the line between financial innovation and deep tech. What makes these players stand out isn't just their tech, it's their timing. They didn't raise this capital in 2021, when crypto was everywhere and nowhere. They raised it in 2025, in the aftermath of regulatory crackdowns, exchange collapses, and VC pullbacks. That tells you one thing: they've built something convincing enough to survive scrutiny, and sophisticated enough to ride the next wave. These aren't hype merchants, they're infrastructure architects. Collectively, they're forming an ecosystem. OSL handles the exchange and custody, DMAL powers the transactions, and SenseTime provides the AI backbone to detect fraud, optimize movement, and manage digital identities. This isn't just vertical integration, it's horizontal dominance. Investors see the synergy and want in before this trifecta becomes the blueprint for fintech ecosystems across other markets. Hong Kong's not just funding companies, it's funding a prototype for global replication. Tokenization goes mainstream. What this means for everyday consumers. For everyday users, tokenization is no longer a concept floating in crypto Twitter threads. It's quietly becoming the back end of their financial lives. Soon, buying a concert ticket, paying a vendor overseas, or securing a microloan may involve tokenized assets whether the consumer realizes it or not. These aren't volatile coins being traded for profit. They're stable, programmable units tied to real-world assets, built to move seamlessly across jurisdictions. This transition matters because it's invisible and inevitable. Much like how cloud computing quietly replaced on-premise servers, tokenized systems are set to replace slow, outdated, and siloed financial pipelines. Imagine payroll arriving instantly through a blockchain channel. Imagine a small business receiving payments in real time without going through banks. These aren't fantasies, they're pilot programs already running under the radar across fintech apps in Hong Kong and beyond. What's remarkable is that fintech firms are building this future without needing mass user education. Consumers don't need to understand the tech, they just need to feel the results. Faster transfers, lower fees, and smarter payments. It's a Trojan horse innovation entering quietly, scaling fast, and changing everything. In a few years, people won't be asking, what is tokenization? They'll be asking, how did we ever bank without it? Is this a bubble or a breakthrough? Global reactions to the $1.5 billion bet. Every major capital injection into crypto comes with the same looming question. Is this another bubble or a true breakthrough? With $1.5 billion suddenly pouring into Hong Kong's digital finance sector, skepticism is inevitable, but the difference this time is where the money is going. Not to meme coins or moonshots, but to infrastructure. That alone separates this from the speculative frenzies of the past. Global reaction is split. Some Western analysts caution that Asia's newfound crypto confidence may outpace demand, while others argue Hong Kong's approach is the model the rest of the world should follow. The presence of licensed platforms, institutional onboarding, and tight regulation is flipping the narrative from Wild West to Wall Street 2.0. Even cautious banks are now eyeing these moves as test cases for their own entry strategies. But the truth is, bubbles and breakthroughs often ride side by side. The key difference lies in timing and discipline. If these firms use their capital to build resilient, scalable, and compliant systems and not just chase headlines, this could be the beginning of a long overdue evolution in finance. The fear of a bubble is valid, but the potential for transformation is far greater. What's happening in Hong Kong isn't a bet on hype, it's a bet on who builds the next foundation of money itself. As the dust settles on Hong Kong's $1.5 billion crypto bet, one thing is crystal clear. This wasn't just a funding round, it was a signal flare, a declaration that the future of money, trust, and digital movement is no longer being quietly theorized in backrooms. It's being built, licensed, and scaled in real time. While skeptics brace for another bubble, insiders are already racing to stake their claims. Whether this marks the dawn of global crypto legitimacy or a calculated overreach, the race has begun, and the finish line is everything we thought we knew about finance.